Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over a bunch of different ratios. It's mainly going to be related to uranium, natural gas, and Baltic Dry Index. We'll take a look at the futures pricing, compare those future pricing to other futures pricings or to other sectors. So it would be like uranium to natural gas to copper, natural gas to Dow Jones, stuff like that. And we'll see how the ratios are performing. And I'm going to throw my financial opinions across the board all over the place. And again, if you guys need help with anything, looking for individual companies, want to join a community where you guys can share thoughts and ideas together, I do have a Discord channel that's tied with the website. You can sign up to the website. We do have discount as the coupon code. So let's dive in. We've got uranium here. We've got this nice bowl shape, and we do have a little bit of selling pressure that occurred this past week. So here's the week there. We came back a little bit. Some people will say or have said on Twitter, if we have such a large deficit, why is uranium selling off? And one thing I want to say there is markets don't go straight up for the most part. You get consolidations, you get pullbacks. The deficit in the future has always existed. And you can see that we've gone up and down in this bull market plenty of times here. We've had some consolidations. It hasn't been a one-way street. Looking at the futures pricing for uranium, I will say this is a very easy bull market to be in compared to some of the other areas like crude oil, nat gas, who have far greater volatility than uranium has had. But I do think that the deficits are out there. It's pretty well known. They are pretty large. A slight increase from Kazatomprom increasing production is not going to impact the supply demand balance out in the mid to late 2020s. And the minuscule amounts that they are going to produce does not cover those deficits. Plus, they've never produced that amount that they say they're going to produce. So we'll see if they can even do it. But uranium looks fantastic. And we've got a little bloody nose. Small down day, and that's generally a continuation pattern to the upside. We'll look at natural gas. We'll go over the individual stuff first. This is the pricing of natural gas. Last bull market, the bottom of 99 all the way to the peak of 2008. That is the bull market. Look at the volatility in natural gas last bull market. Pretty insane. This is the fractal I grabbed of last bull market. If you want to see the ups and downs, and again, a lot of this is weather dependent. Hurricanes, cold weather in the winter, warm weather in the summers. It has an impact on nat gas. Now, if we were to take this fractal here that I grabbed and put it over the new bull market, it looks pretty similar. This is the fractal. I didn't even change it. This is the fractal from back here, last bull market. You can see that we came back down quite dramatically, and we are breaking back to the upside for natural gas futures pricing. So we could see a big move in natural gas over the next weeks and months, which is possible. And that is what natural gas had done last bull market, is it went all the way up to looks like $8 or so. Will it do it this time? I don't know. We'll have to see. But we've got a nice little breakout here in the short term. And then Baltic Dry Index is another one that I think looks pretty good and cheap. This thing is absolutely ripping it. This is some of the companies I talk about on the website, natural gas and Baltic Dry Index and other areas that could potentially go up from these large valuation discrepancies. Falling wedge in the three hump consolidation, false breakdown or breakout on the downside, popped higher, had that little pullback, and here we are ripping to the upside. So Baltic Dry Index, at least from this perspective, looks very good. If you were to throw kind of a projected price move It's probably going to be something like that. We are going to go way higher from this falling wedge pattern. We have a long way to run for Baltic Dry Index. Now, let's move down to some of the ratios and see how the ratios are behaving against each other, see what they're doing. So I'm going to go into uranium first. We'll take the big picture view. Everything looks good in uranium against silver. We can see that we have a nice big breakout and a little bloody nose. You know, there are people talking about potential yield curve on inversion. So the yield curve on inverts. There could be a slowdown at some point where some of this might change. It is possible. But looking at this chart and the way it looks, uranium is still king at the moment. So uranium looks really good. Uranium is outpacing the S&P 500. You can see the clear breakout. There's your little bloody nose that we got last week. Uranium versus gold is definitely broken out. No question if, ands, or buts there. And we got our little nose. Uranium versus crude oil. This is more of an even match. We're going back and forth. But at the moment, uranium is outperforming crude oil. We've got uranium versus copper. Again, it is outperforming, and we got that little bloody nose last week, and it still looks good to continue to outperform. Uranium versus natural gas. Now, natural gas, I posted this on Twitter and said, are we going to see, what's going to happen here? We are at a very cheap price for natural gas. I think nat gas is going to outperform uranium here in the short term. I really do. And then we have uranium versus Dow Jones. We are getting that bloody nose. I think it's going to go higher for uranium. That's looking good. We've got uranium versus platinum. No ifs, ands, or buts there. Uranium's kicking butt. Then we've got uranium versus the M2 money supply, and it is also killing it to the upside with a little bloody nose from last week. So I do expect this to continue higher. Now, switching gears over to natural gas. So natural gas, here's natural gas versus platinum. Very cheap level down here, and it is accelerating to the upside. The past week or two has been a pretty big move in nat gas, and to me, this looks like we could see absolute domination at least to 0.008, which would be a double in the ratio, is possible. Now, again, we're looking at ratios, and sometimes it doesn't work out the way that you want. But undeniably, natural gas is cheap to platinum. Natural gas to gold, again, we are very, very cheap down here. We are in no man's land. And we are starting to come back up, which means that natural gas is outperforming gold. We've got natural gas versus uranium. We are at a very, very, very cheap area for natural gas. And we are starting to get some outperformance for natural gas. Is this going to launch to the upside? I don't know, but I can just say natural gas is cheap to uranium, and natural gas has been cheap to all the other areas that we've looked at. So I think that both of these, natural gas and uranium, undeniably are cheap against all the other assets. Nat gas versus crude oil. Whoa, whoa, whoa! What is this? This went below. We had a little breakout here, boys. What is going on here? I think we could see a snapback. Little slingshot cheetah action going on, if you know what that is. If you know what the slingshot cheetah is, put it in the comment section what exactly I'm talking about. But there we are. I think we could see an outperformance of nat gas versus crude oil, and we are coming from extreme cheap valuations. Nat gas versus copper, again, extreme valuation. And we are starting to outperform to the upside. Go natural gas. Natural gas versus Dow Jones, another extreme valuation down here in no man's land. Look at that. Only a few times in history, it's cheaper today than it was. We're down here today. It was cheaper today than all of last bull market. I think over the next couple of years, we could see a good outperformance here to the upside. Good outperformance. And we could see nat gas move towards the world pricing. this natural gas. So natural gas towards TTF Dutch. We've got natural gas versus palladium. Again, super cheap, and we are starting to move higher in that ratio. We also have natural gas versus Baltic Dry Index. Natural gas is cheap to the Baltic Dry Index, and I think Baltic Dry Index looks good. We're looking at some of the cheapest assets in the world. Coming to, let me see, I don't know if I have BDI here. We've got one BDI. This is Baltic Dry Index versus gold. We talked about it being down here in no man's land, breaking a falling wedge. And there it is, breaking to the upside for Baltic Dry Index. I don't know if I have all the other Baltic. Let me look real quick, see if I've got more BDIs down here, which I do. So here's BDI versus gold. Again, we're breaking to the upside. We just talked about that one. Baltic Dry Index to crude oil. See that BDI is super cheap, and we're starting to outperform. We are at a critical level here where there's a little bit of resistance going across here, and we're about to break out of that resistance. You can almost say that this is a shoulder, a head, and a shoulder that's inverted that we're ready to break to the upside. So Baltic Dry Index looks fantastic. We've got Baltic Dry Index versus copper. That is also at a very cheap level, and it's starting to outperform. We could see a large outperformance of BDI. BDI versus silver. Look at this, starting to come on up. Are we going to see continued outperformance of Baltic Dry Index? Looks like the past couple of days, silver's been killing it, but we'll see what happens here over the long term. We've got Baltic Dry Index over iron ore. Again, it looks pretty good. We've got the green army showing up. There is a little bit of selling pressure throughout there. And it looks like we've got a trend line coming through here. I couldn't grab that, so I'll put the trend line there and look good. Then Baltic Dry Index versus uranium, as weird as this seems, but Baltic Dry Index, like it might outperform uranium to be possible. So lots of opportunities across the board here, guys. And I am looking at all those opportunities for those that are members on the website. I'll share my individual stock picks with you guys for Baltic, dry bulk shipping or natural gas companies. We just came off a bottom in nat gas in some of these companies that we've been talking about. Hopefully you guys got a chance to feed the portfolio with whatever you'd like. Obviously, I can't give advice, but I can tell you what I'm doing, why I'm approaching some of these markets the way I am. We do have a question and answer session coming up on Sunday at 5 p.m. I'll talk about my approach, how I approach those companies so you guys can learn what I am doing so you can do it for yourself. That is where the value is in all of this stuff, guys. I mean, I'm going over the ratios here. Let me just describe what it is real quick, okay? Ratios are telling us relative value, and that's all you have in the markets is relative value. When an asset becomes expensive against another one, it means the money went to this asset, not in this one that's cheap. Over time, given certain market conditions, like an inflationary condition with increasing interest rates, we could see this money go from this sector to this sector and rotate between sectors. The relative valuations change. When someone asks, when this is what a lot of people do, and I'll go over this real quick. So this is what a lot of people do. They'll say, I want 10 stocks that are diversified across a bunch of different areas, and I want to invest in them. I don't do that approach. What my approach is that I look at the ratios and tell me what's cheap. Then I invest in what's cheap at the time. And what happens is when the cheap guys start to become more expensive, I don't add money to them anymore. I stop talking about them. If you notice, I added a lot of money into oil. I don't talk about oil that often. I mean, yes, I'm an oil bull, but do you see me saying that oil's cheap right now? No, there's better opportunities. There's natural gas, there's Baltic Dry Index, there's uranium, and those are going to change throughout the commodity bull market. Do I know the exact rotation? No, I don't need to. I don't need to know this goes to this, goes to this in some predetermined way. I'm going to be fluid and just say, look, right now, Baltic Dry Index, natural gas, and uranium are cheap when compared to other sectors. Nat gas and Baltic Dry Index look to be some of the cheapest. And I'll do the metals later in a different clip. We'll talk about platinum, silver, and all those other ones. But here, these are three that are standouts that are energy related. These are all energy and or energy related. Baltic Dry Index goes up with energy. So these are all interconnected. They go up when energy goes up. Now, there could be a slowdown in the market, and these may stay cheap. But your downside, I don't think is that your downside is limited because your valuations are so blown out to the downside. These things are already way down. If you're in something that is very richly valued, you have a lot of risk to the downside, aka technology stocks. If we get a slowdown with the yield curve potentially uninverting, maybe it doesn't. Maybe it doesn't get a slowdown. So what I do is I prefer to go after the value in the market where the money isn't. And if the money isn't there, who's there to sell? I mean, it'll still go down, but I don't think it will go down that much. So it's a little bit of protection to the downside and a lot of upside potential. That's exactly what I zoom in on. So I look for these alignments, guys. I look for the alignments. What are the alignments? The first thing is inflation. If we're going to be investing in commodities, they go up during inflationary periods. They go up when there's inflation and interest rates go up behind that inflation. You have to look for an inflationary period. That's step number one. Step number two, what you look behind it when you want the alignment is you want commodities to start to outperform stocks. So when we look at that, and we look at that valuation, we want commodities to basically bottom. And we have that alignment. That's the alignment. The downtrend's broken. We are starting to get commodities to outperform stocks. So step number one, inflationary period with increasing interest. Step number two, we want to look for commodity outperformance. And we can also look at yields. Yields moving up, you can see we've broken that downtrend line and we're starting to move higher. In the short term, it's very possible that this could pull back. I understand that, guys, but we're looking for a secular bull market. We're not looking for cyclical little tiny moves within the big move. So step number two, increasing interest rates, inflation, and commodities start to outperform the S&P 500. And what that is putting the tailwinds at our back there. Then we start cherry picking our sectors of what I just did today. Start cherry picking those sectors. Those are the three sectors that I think look really good. Now, in the beginning, when interest rates hadn't really moved yet on the 2020 bottom, the ones that looked the best at the bottom were nat gas, oil, and uranium. Now, oil was up at an anomaly. If you get above a 30-to-1 ratio against, we can look at it here. So it's going to be gold price divided by crude oil. When you get above 30, that's that white line I have there. That is an anomaly. This is the period that you saw back in 2020. You look at the ratio. It went all the way up to like infinity because negative. But that was your opportunity, guys. This is an anomaly in history that will probably happen very few times in a lifetime, if ever again. Now we're starting to work our way lower. We're at 22 right now for gold to oil, and that is still an incredibly cheap level. An expensive level is anything under 10. Average is 15. To give you guys kind of a normal, what's normal? 15 is the average. We're at 22. It's still cheap. What does this mean? It means that we've got a lot of upside in a lot of different commodity sectors. A lot. In my opinion, I think that so most of these occur under an inflationary period, which is the expansion phase of real estate. That's the whole thesis. You get the alignment there, inflation, interest rates, then you get your commodity to stock ratio starts to move up. Then you dive into your sectors to find what's cheap. And then you start looking at the technical analysis of individual companies within those sectors that are layered deeply into this alignment. And if we can get a full alignment, when you go big, that's where you can add into companies at very opportune times and make a lot of money. That's how you do it. Just the way I described. Inflationary period or a disinflationary period, you're just going to have different investments behind it. All these things cycle, go through one big cycle. The cycle is technology stocks, goes into, which will be then commodity stocks and expansionary phase of real estate. Then when it starts to turn, you want to get into bonds or gold. Bonds or gold at the top, start coming back down into a recession. That's where bonds and gold go. And then when we bottom out, generally that's where tech stocks do very well. at that bottom, and then there's generally a reflation in back into the market. Now, usually the crash occurs from a recession or a slowdown in the real estate market. Are we going to have a slowdown? That is not pertained to the real estate market because we've held rates at a low rate for a very long time. Rates are starting to come back up, or are coming back up, and we could see problems in the system somewhere, a flush out. It could be whatever it is. I don't know what it is. Bankruptcies in businesses, commercial real estate, something happens, right? And we could get a slowdown that is unrelated to the real estate market based off of the increased interest rates and a flush out of junk in the system. It's going to be hard to know exactly what is going to start this slowdown and how big it will be. Don't know. So the way that I view it is I'm going to ride through it. It's going to be ugly, but I'm going to ride through it. And you could see a 30% pullback or more. It's possible. And I'm going to talk about this a lot. I'm going to show you guys the alignments that I'm looking for with the all this stuff at the question and answer session Sunday here. And get you guys, you're going to have to make decisions for yourself on what you want to do, how you want to allocate the portfolio. And obviously, all this is really big on portfolio allocation. That is very important becoming a successful investor. How you allocate portfolio, what do you do with cash flow companies versus speculative companies? Do you even know the difference between and I'll go over all that during the question and answer session that's coming up on the approach here and potential things that you could potentially do or what I'm going to potentially do. Put it that way, not you. And you can see what's going on. So thumb up for the content, subscribe to the channel, subscribe to the website if you guys like, discount coupon code if you want to. And we'll catch you guys on Sunday. Yeah.